All right, so let's take a look at the financials for Shoot and Burn Photography. And just a little bit of background because it's important to know a couple things about the financials that you're looking at. So this entity is a photography studio set up as a single member LLC, but they decided to be taxed as an S corporation. So that's important to know. Once we look at the profit and loss, you'll see a couple different things show up there that are related to the owner paying themselves. And they're also a cash basis taxpayer. So you notice that on the balance sheet here, we don't see any accounts receivable or accounts payable because those are all related to accrual basis taxpayers. And this entity is a cash basis taxpayer. So just looking at the balance sheet as a whole, you'll notice a couple things. So at the top here, I'll highlight our assets. And always remember that your assets always have to equal your total liabilities plus your equity. So if we look at the bottom here, our total liabilities and equity are that same $52,113. And I'll highlight here, our liabilities go here. And then our equity section is here. And I can prove that assets minus liabilities minus equity, we have a variance of 0, which means that our balance sheet balances. All right, so let's take off these highlights and let's walk down the balance sheet. So let me scroll into the assets. So this is Shoot and Burn Photography. And you can see that their total cash in their bank accounts, they have 3 bank accounts here. The total is $46,888. Now this is all the cash they have. This is their liquid cash that they can use to pay for overhead expenses, any other expenses that come up, cost of goods sold expenses if they sell an item, and also pay themselves a healthy monthly salary, which you'll see when we get to the profit and loss. And underneath their bank accounts is a current asset, and that's called undeposited funds. And essentially what this represents is, this is when you tell your books, hey, I received $3,500 from a client. So the invoice in QuickBooks will be marked as paid, and that'll then show up on your profit and loss statement as $3,500 received. However, the money hasn't yet hit the bank account. So normally the money gets deposited into this checking account. And since the amount hasn't cleared yet, it doesn't show up in the checking account because again, this is a cash basis taxpayer. So they only reflect money that actually hits the checking account. So that's why we have this $3,500 because that hasn't yet been deposited. But as soon as it does get put into the bank balance will increase by $3,500, and then the undeposited funds will decrease by $3,500. And then you'll see here that we have the same current assets because all we did was move that $3,500 into the bank accounts. So let me undo what I did. All right, so we talked about the other current assets, and you'll see here that the last section in the asset section is for fixed assets. And again, these are items that we will utilize over a long period of time in the business. So we're able to capitalize them because they're assets of the business, and then every year take a little bit more depreciation. And that's depreciation is basically recognizing the expense. So these items were purchased and money was put out from the business owner. However, the full expense hasn't been recognized yet. So we still have $1,724 of depreciation expense to take in a future year. So that's an expense for something that we paid for a while ago, but haven't yet got the full benefit of in terms of tax deductions. And that's it. This is your total assets, $52,113. And then we go down to our liabilities, and this taxpayer has a very clean balance sheet. So there's not even a credit card balance that is still owed because the balance is paid every single month on time. If we keep going down, there's payroll taxes that are payable. That's also 0. So all the payroll taxes that have been withheld from employees have been paid into the governments. And then there's a section for sales tax payable. So sales tax payable represents items that were invoiced to clients. For an example, maybe the charge was $100 and in PA, there's a 6% sales tax. So that $6 that you receive, when you receive it, would go into this PA Department of Revenue payable, increasing your liability because you collected that $6 from the customer, but you actually owe it to Pennsylvania. So you need to keep that on your balance sheet because you need to know how much you need to hand over to Pennsylvania when it's time. So in total, this taxpayer owes $423.81 to Pennsylvania. And again, that's as of August 31st, 2021. If I change the date to September 1st and more invoices got paid, you'd see this number increase. And if I ran a report as of September 21st, when the amount to PA was due on September 20th, it's due the 20th of every month, you'd see this amount go down because cash would go out of the bank and the liability would be paid off. So the only thing sitting in long-term liabilities is the auto loan payable. And this is for a company vehicle, the same vehicle that's up here, the Ford. This won't be paid off in the next year. This will be paid off in a couple of years. So that's why it's sitting in long-term liabilities, because this $12,000 shown as the auto loan isn't due within the next year. And then lastly, we go down to our equity section. So you'll see at the beginning of the year, as of 1/1/21, there was retained earnings in the business of $19,013. Since the beginning of the year, the owner has taken out $9,458 and has generated net income of $30,094. So the total equity in the business, the $30,000 plus the $19,000 of retained earnings, gets you to $49,000. But then we have to factor in all of the amounts that the owner took out of the business, which was $94,663. So in total, the equity as of 8/31 is $39,650. And that represents the total equity that the owner has in the business as of 8/31. Now, if the owner takes out $39,650 from the bank account, because there is that much in the bank account, and the equity goes to zero, and there's no equity left in the business. So if it was sold tomorrow, there would be no basis in the entity, or no cost basis. So that's important to keep in mind. You want to make sure you always have positive equity in the business. All right, so let's go check out if our net income on our balance sheet matches our profit and loss net income. We'll click over to profit and loss, and you can see the net income here, $30,094, matches exactly what is on our balance sheet. So let's scroll up, and again, Shoot and Burn Photography is a photography studio that reports their income on a cash basis, so as they receive the money. And they're a single member LLC taxed as an S corporation, which means that the owner can pay themselves a W-2 payroll. So let's take a look at this profit and loss. And you'll notice something different about this profit and loss. I ran it from January to August 2021, but within QuickBooks, I told it to give me the numbers on a quarterly basis. So you can see here that January to March, April to June, and then July and August, since the quarter isn't technically done yet, is shown here. And this will allow me to see when my income is coming in. So when are the final wedding payments coming in? When am I doing my most session work? When are albums selling? If I'm into other things like mentoring and teaching, those will show up here, and you can see where income is earned. We also get to see that refunds and allowances are broken out separately because I had to refund somebody a final payment. So you take a look at your income by quarter, and then you also want to take a look at your cost of goods sold. And this is really important to know what it costs you to generate these sales. So just a simple formula. To figure out what your gross profit percentage is, just take your gross profit total for the first 8 months of the year and divide it by your total income. So for every dollar that you bring in, you're keeping 78 cents. Another way of saying that, if you take your cost divided by your sales, another way of saying that is that for every dollar you bring in, you're paying out 22% to make that sale. And that 22% is made up of processing fees, print and album products that you're giving to clients, QuickBooks payment fees, subcontractors that are helping you work the event, and then just miscellaneous supplies and materials, things that you'll kind of use on the day of a wedding and then never use again. But that's very important to know because now you know that for every dollar that comes in, you have to pay out about 22%. So this will help you plan and budget, because now that you know you get to keep 78%, that 78% goes to things like your overhead expenses, which are shown below gross profit here. So here's the overhead expenses for the first 8 months or so. We have the normal things like advertising, bank charges, camera equipment, client gifts, continuing education, computer stuff, dues and subscriptions, legal and professional fees, meals and entertainment. We have this office expenses, which we should probably look into, because unless there was a big return for something purchased in 2020, the year prior, there shouldn't really be a negative expense here. So either this was misposted and should be posted to a different account, like dues and subscriptions maybe, or something was purchased at the end of the year last year. So that purchase was on that P&L, and then early in 2021 it was returned. So that's why we have a negative amount here. The payroll expenses are the processing fees to actually process the payroll. We have some rent and some other miscellaneous expenses, but in total, operating expenses for the first 8 months of the year, your overhead expenses, total of $18,000. So that's about $2,300 per month. That's really important to know, that you can assume that you're going to have about $2,300 of cost every month, regardless of whether you sell anything or not. And then lastly, like I said, this is an S corporation, so they pay an officer payroll. So you might look at this and say, wow, tough for the Shoot and Burn Photography owner, because they only walked away with $30,000 for the first 8 months, and they still didn't even pay any income tax yet. So not all of that $30,000 is theirs to keep. But keep in mind that since they are officers of the entity and they own the entity, they're allowed to take a payroll. So technically, their real earnings are this $40,000 that they paid themselves via payroll plus the $30,000. So in total, now we're talking about a $70,000 profit or net income. And that $40,000 that was paid via payroll already had some taxes withheld. So depending on how much federal income taxes were withheld on that amount, you're probably covering your tax on this $40,000 already. What's left to be taxed is that $30,000. And since it's an S corporation, it's only subject to ordinary income tax, not self-employment tax. So this owner has pretty good books, in pretty good shape. They've taken about a little over half of their earnings in payroll, which is a good split. And they're running a profitable business. And obviously, if you know anything about weddings, September and October are pretty popular for weddings because it's a little bit cooler. Everyone's kind of around, no one's on vacation. So this owner is going into the fall very poised to do really well for 2021. Their overhead is under control. It's not excessive or exorbitant. They have a really good gross profit on their services, and they're able to save a lot of cash. So this is a company that's in really good financial shape. And lastly, let's take a look at the statement of cash flows. And as you can see from our balance sheet, there's not too much going on because there's just a little bit of sales tax payable every month, some Amex credit card payments, and then this auto loan. But other than that, it's pretty simple. There's not a ton of investments or any other significant cash flow items. So we'll take a look at this, and basically you start with your net income at the top, and the net income is adjusted. Statement of cash flows sometimes shows up on an accrual basis, and then an adjustment for accounts receivable is made to get it to cash basis. So then you factor in your sales tax that you collected, and you end up with net cash provided by operating activities of $29,000. There's no investing activities because, again, there's no investments on the books or any other activity that would require the cash in and out to be shown in the investing activity section. So the last thing is the financing activities, and that summarizes all of the equity transactions that occurred during the year and also the loan payable paydowns for the auto loan. So net, you have $10,000 of cash used by financing activities. And you can see this is a negative amount. So the net cash increase for the period is the difference between that $29,000 and the $10,000. And that's an $18,000 increase. And at the beginning of the year, we started with $31,000 of cash. So add that 18 and we get to our $50,388 of cash. That's pretty much it. It's not terribly complicated. It just takes some getting used to.
If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.